When I left off in our last screencast, we were talking about our adjusting journal entries, and we had gone through our first two journal entries dealing with supplies expense and depreciation expense. Now, our next journal entry on the 31st of May is for salaries. Salaries of $2,100 are accrued but unpaid on May 31st. And what this means is that we had employees who, in this case, are paid twice a month on the 1st and the 15th, and they have accrued salaries. So these salaries will be paid on the 1st when the employees get paid, but the employees worked for the last 2 weeks of May, and so they earned that money, and so that is an expense to us, and we'd like to match our expenses with our revenues, and those employees work to earn revenues for our consulting firm. And so we need to accrue and take into account those salaries for the month. We're matching the expense to when the revenue was created. So in this case, what we do is we create salaries expense. We debit salaries expense for $2,100. And then we create this payable. We owe our employees money, salaries payable of $2,100. Now on June 1st, we will debit salaries payable for that $2,100 when we pay that check, and we will credit our cash. But at this point, we just owe our employees money. And so we create an adjusting journal entry for that. Now, our final piece of information is that the interest rate on the note payable, which we got that note payable on the 26th of May from the bank for $5,000, that interest rate is 6%. Now, when you get something like this, it is an annual rate, 6%. So every year, we are going to pay 6% on that $5,000. And we're not going to record what we owe in interest every single day. That would be inefficient. But we are going to do it at the end of the month. So in this case, we take the $5,000 loan and we multiply it by 6%, and then we multiply that by 1/12 because we're taking 1 month out of the 12-month year. And this gives us $25. So for the month of May, we have interest expense of $2,500, and we have interest payable of $2,500. We owe the bank $25 in interest. Now, you may notice in all of these journal entries, you are always going to hit, when you do an adjusting journal entry, one income statement account. That would be an expense or a revenue. In this case, it's all expenses, and one balance sheet account. Supplies are asset, accumulated depreciation is a contra asset, salaries payable and interest payable are liabilities. So this is the way it's always going to be when you're doing journal entries, adjusting journal entries. You will have an income statement account and a balance sheet account. In the next screencast, we'll move on to posting these to the ledger and putting them into our adjusted trial balance.